I know what you're thinking. Do we want to get into this territory?
Let's just see where we land.
No. I'm a little bit worried actually too.
Yeah, it's one of the worst states to basically provide housing there, which is great at making a killing because it just keeps going up in value. But it just shows how long it's taken the government to allow properties to be produced in these areas where they're just having massive amounts of people moving in. This is the reason why we built Crystal. Crystal, the AI market predictive technology we've been using, analyzes the GDP, GSP, GRP, available housing, housing income, economic drivers, infrastructure projects, all these
goes.
the debt income ratio.
I reckon you said that once or twice before. Where's your ideal 2026 location to be buying property in? Let's take it down to the metropolitan or regional area. Welcome to the Lazy Equity Podcast. Finally in our new office, the third office in the last 12 months, I think it is, and also a reason for us not putting out content for a while. So thanks for all the patience. We're really looking forward to getting stuck back into the series and uncovering what is making the property market in Australia tick and all the ins and outs that you guys need to know and consider when buying property. Today, I'm joined by my two partners and directors at the Investors Agency. Thanks, guys, for joining, Justin and Mike. Obviously, it's been a while since we've done this, as I've said, and it's been a great testament to the effort that you guys have both put in by growing the business and making us move offices multiple times. But yeah, thanks very much. And 26 is going to be a really great year for us. Well, I think let's get into it, guys. Let's get into the topics. We've got some things that we want to uncover. A lot of these topics have been brought to us probably more recently than what the past has brought through to us. And a lot of them obviously coming through from a lot of the calls from your team, Justin, the sales team, who are basically supporting the intake of clients into the company and raising a lot of questions around what they need to know and what they need to consider going into those purchases and what they need to plan for. So let's go into the topic of when to buy, hold, and sell. I know that one gets raised quite a bit.
Yeah, definitely. Maybe starting with the when to sell, we seem to get that one quite a bit. Reason for that, people want to know, will we tell them when to sell when a market's kind of reached its affordability limit? Is it time for them to get out? A couple of ways you can look at it. Personally, what we usually tell people is that only two times to really justify selling. Firstly, when your serviceability has been capped out, so you can't buy anymore. Property may have doubled in 5 years and it's maxed out your serviceability, the capability to buy more properties. So you start to work into the opportunity cost. Am I losing out by not buying? So that's something to look at. Secondly, transitioning from wealth creation to cash flow. So as much as we try and tell people, make as much money through the capital growth first before we transition to cash flow. So we enter those cash flow asset classes at a much, much higher price point. So yeah, we usually say the second time to sell is when we're transitioning from wealth creation to cash flow. So we've made quite a bit of capital. Now we want to start selling down a portfolio and have, maybe sell down 5 out of the 10 properties, have 5 fully paid off properties generating that cash flow, or on things like commercial. Commercial, we want to enter at a much, much higher starting point. So something around the sales side. What are you guys' opinion on when to sell?
Yeah, I think personally it comes down to the investor itself and what's your strategies, what your goals are. Another topic we're going to talk about in a minute is regional versus metro, and that kind of comes into play a little bit. But if you're the type of person who is a little bit risk adverse, and you're not going to be the type of person who's going to jump into a market and want to jump in and then 3 years sell and then jump into another one and then play that game. That's quite an aggressive model. So I think it really needs to match your personality type and your risk tolerance when you're looking at investing, because I guess one shoe doesn't fit all.
And your strategy. I mean, there's multiple strategies that consider the benefits of selling at different times as well. If you're looking at buying within your self-managed super fund, there's very big tax benefits when selling in the super fund. There's only a 10% capital gains tax implication on that actual sale of the asset inside the fund. Obviously, you have to keep all the profits inside that fund. And so if you are a very active investor, then it's going to be quite beneficial for you to, maybe start playing on that game and figure out if it's actually going to afford you. And I think being an aggressive investor, one of those things that we like to look at is the types of market that benefit aggressive investors as well, or even passive investors.
You say ideally, if you can hold the property, it's great because essentially it's going to be positive cash flow within hopefully a couple of years if you buy the right market at the right time for the right price. Secondly, if you can redraw the equity, use the equity to buy your next property rather than actually have to pay all the capital gains tax, all the transaction fees. Real estate, it's not a liquid asset class.
Purchase costs, all those types 100%. Of things. Yeah.
a way of actually being able to hold the properties. This is what happens with so many high income earners that we're finding as well that come into the business. They've all had these really bad experiences, high income, 600-700 grand a year. They get told by their accountant, financial advisor, buy all these properties and they're all negative cash flow, which, you know, we don't want to get too far negative cash flow. Their accountants and advisors saying it's great though, because it's reducing your taxes. They lose their high income job. Now they're stuck with $150,000 worth of repayments. They can't afford, they're forced to sell. A way to try to combat that, when you redraw the equity, only put 80% down to buy the property and then use that as your cost, the deposit, the stamp duty. Use the other 20% offset account. Have that 20% as a buffer.
Such a great strategy.
Yeah, 100%. So it's coming out that buys you time. That could be a year or two where you don't have to come up with the repayments because you've got the equity covering it.
Absolutely. And I think that's massively overlooked. You know, playing on that as well, when you are taking out a loan, and if you are obviously, you know, creating that much money, a lot of the times those people are not PAYG employees. They actually own their own companies, and then company structure becomes a big thing as well. So wrapping that up, it becomes a bit of a tax play. Obviously we can't talk about tax, but when you own your own business and you are creating that kind of income, it does make sense at stages, but it also then makes you very vulnerable to not just you running your business, but you're also then, you know, running the course of a gauntlet through property markets, which you really have to trust and consider them to, you know, keep your fortunes safe for the years to come. And I think that's just a little bit too much risk for my appetite.
Yeah. I mean, that strategy you just spoke about, that's often used when someone's making that short-term play where they're jumping into a market, holding for 2 or 3 years, getting to, you know, X amount of equity or capital growth and then pulling out, and they're actually not using their own cash to do any of it. So it is quite often used in short-term plays, and it seems to work.
Yeah. On the short-term play side of things, when we're talking about different markets that benefit these short-term plays, we get a lot of different activity and response timeframes in terms of which property markets are growing at what different rates, and they're very well, or rather it's quite easy to see the position of these markets playing a big part of the actual growth rates. We see in regional markets where you got a lot more of a stronger return in a much shorter time frame than you do inside the metropolitan markets. However, the metropolitan markets typically run for a longer time frame. And these are going to benefit the different types of investors, those more conservative or potentially less active, more of a passive approach, versus the regional investor who's going to look for a property market that is quite active. It allows them to get up there a lot quicker, allows them to pull out their funds a lot faster and go into new assets from the equities which have been risen. I want to hear your guys' take on what you prefer as an investor yourselves personally.
Yeah, in regards to the regional or metro, or short-term as long-term holds?
Well, I think it's a bit of both, isn't it? I mean, the short-term hold really comes from the idea of regionals. Not really short-term hold. I mean, I'm always in the market to hold property forever, but it's more around getting that equity base to build up as quick as possible. There may be some stagnation periods which come more commonly within regional markets than they do from the metropolitan markets. But I'm of the assumption that if I can make equity fast and I can redraw that quicker and put it into another deposit for another asset, which is now doubling the volume or doubling the value of the portfolio, and I can now capitalize at the same aggressive pace inside that market, I would way rather want to do that. But that's my opinion. I'd love to hear yours.
It's one of those things, I always say there's no such thing as the Australian property cycle. Every single market's on a different cycle. And for you to just look at it as numbers on a spreadsheet, regional markets allows you to get in a much lower price point, higher rental yields, and it allows you to redraw that equity quicker, because sometimes they can grow a lot quicker than metro. I feel people get fixated on metro just because they have that emotional connection, that emotional tie, thinking they feel so much safer. As we were talking about earlier the day about the risk profiles, how is someone's risk profile, their palatability of actually tampering in these markets as well. But ideally, I would love to hold as much as possible for as long as possible. My biggest regret is selling. Some of the properties I bought tripled in like just a few years, but I sold too early because I kept getting stuck, thought I had to sell to move on to the next property. There's always ways to move forward.
Yeah, what about you,
Very
Mike?
interesting. I personally think that, and the way I've gone about it is to try to have the properties I have, which are metro properties, as the foundation, and the hold properties. And then being a bit more aggressive on the regional and shorter term plays. You know, when you're getting into places like Sydney and things like that, it's not as easy to jump in and out because of the price points. So it does make it a lot harder to try and be aggressive there and, jump into a market, wait 3 years and jump out because, But
that's the other side of it. I mean, if you do jump in and jump out, if you're talking about selling at least, the opportunity costs, or rather the selling costs of, letting go of a property are significant. And if you are going to sell a property, you have to consider then buying a property if your intention is to at least expand the portfolio. So you're going to lose your profits to your agent fees, and then you're going to spend more profits to more agent fees and potentially stamp duties as well, obviously, because you can't buy a property these days without a stamp duty cost.
Absolutely.
So these are the things that are reality, and you do need to consider selling, or if you do consider selling, these really the realities that you have to consider. Actually, you just mentioned over there, going into regional markets does stimulate the fast growth as well as fast rent returns too. And I think that's one of my favorite things around markets is that you do get the ability to stimulate rent, so that when your equity, because equity builds up typically a lot faster inside those regional markets, you can also then capitalize a lot quicker on the rent. And as a lower income earner, they need all the servicing support that they can actually get. So once that equity is there, and if the property market and the rental market rather, inside that area is supporting the new servicing ability of their next purchase, then I think why not? I think it's a much better play personally to go and expand that portfolio through not just the strong equity, but also the strong cash flow that supports the serviceability.
I 100% agree. It's yields keep you in the game, but growth gets you out of the game. Sometimes you need those stronger yields so you can keep on buying, getting into the next property quicker, and you have multiple assets all compounding, all growing. The longer run, you should be a lot further ahead rather than just having all your eggs just in one property. So this is the reason why we built Crystal. Crystal, the AI market predictive technology we've been using, analyzes the GDP, GSP, GRP, available housing income, economic drivers, infrastructure projects, all these the debt income ratio.
I reckon you said that once or twice before. But it does. It's really exciting too. It doesn't really tell us what the policies are exactly, but it definitely flags the signals of change. And in all the states and territories, Victoria has the most conservative change on rental prices in comparison to value prices. Obviously, it also has been one of the states that has had the least amount of growth historically for the last recent couple of years or several years.
10 years, I think.
10 years.
Yeah, it's been significant amount of time.
Which does give it the runway for a lot of potential growth. But the policy's in the way, which has been great for the population that are residing there. And I think that's probably going to really bolster the long-term trajectory of what Victoria actually will hold in terms of an investable outfit for investors, because there is going to be that stronger attraction to homeowners and longer term tenants that want to have a better lifestyle through affordability, because it is one of the more affordable rental zones in accordance to the incomes. And I think that eventually will play a good part in the investors' landscape as well. And we've already started to see it work.
I mean, I think in the short term, yes, it's definitely benefiting the people of Victoria. But in the long term, I would argue that at some point they are going to have a spike, because it is going to become, as the rest
Perth.
of the country, it is going to become the Perth, and it's going to go up very quickly and very sharply, and it's going to be very shocking for them when that does happen. Because exactly, Perth was very affordable for a long time, and we've seen what's happened there.
Yeah. Well, we've already started seeing the change in a lot of the markets that we're buying inside Victoria. But the greater scheme will be coming, as we can see in Crystal at least, is probably around 16 months away in terms of the greater landscape of the Victorian metropolitan markets. There's also a lot of interest inside the unit markets inside the CBD of Melbourne. And I think this is not coming from us, but because I am hesitant to units. But what we are seeing is very much a swing of ability of these markets starting to turn in the future. Not yet, because it's still a high vacancy rate, but it more comes from an affordability pay from buyers entering the markets, turning that investor market of apartments into more of an owner-occupied market. And that's where it's trending at the moment. It's not there yet, but it will be interesting to see in the next sort of 12 to 16 months where that lands.
Couldn't agree more.
Victoria, or I guess Melbourne, is predicted to be the biggest city in Australia soon, just in regards to the amount of people moving there. I guess the difference between Sydney and Melbourne is Sydney's landlocked. You got ocean on one side, national forest on the other side. They can't keep building. Whereas in Melbourne, it's flat. They can just keep on building out and out. So therefore, it just allows for a lot more population to keep coming into that area.
Some of the population forecasts that we're looking at for certain parts of Victoria are insane.
70% in the next, 10 years?
Yeah, 80, 90% in 10 to 20 years. Yeah.
Yeah.
It's insane.
Yeah, you made a good point the other day. It's every major city in Australia is still in a growth cycle because there's just so many people coming to the country that can't build fast enough.
Yeah.
So it doesn't matter where you're buying those major cities.
Yeah.
When the tide rises, all the ships go with it. So
An interesting one is Perth, WA. It's still going, and
It's still going.
it's the locomotive that keeps on chugging.
Yeah.
It's an interesting play, though. I'm keen to hear what your ideas are on Perth for the future.
Oh, it's a tricky one, but I mean, the more that we look at the data, it's still affordable. The yields are still strong. The projects, infrastructure projects, and the money being spent by the government is strong. The population forecasts are incredible. So I still think it has quite a good runway. I know it's done really well in the last, say, 4 to 5 years, but historically we also know that markets can grow up to 10 years. Historically, when we look back at what other states and areas have done. So while it's done really well, it still looks like it's going to keep going.
Yeah, and I think that's partly supported. I'll put my fingers in inverted commas, supported by the ill decisions of the government and the housing support and supply. And a detriment to the people and the population is a reward to investors in the situation, is the reality of it, which is the hard truth. But you know, we are in a country where property has been a valued asset and a valued commodity for an extremely long time. It's not like it's changed. It's just got a little bit more aggressive. It's still there, and I think it'll be there for a long time. When we've got that much red tape around the ability to expand and to support, I just don't think that this is a quick fix that can be overcome. And you know, as these decisions get made, other areas will start to be influenced as unaffordability comes in and creeps into those markets. More areas will become more affordable. And I think, grand scheme of things, we can see markets back in New South Wales starting to erupt again. And we can see Tasmania starting to go again.
Absolutely.
And this is exciting for us as investors because it's opportunity that is recycling itself, really.
Yeah.
Keen to wrap this up, guys. Your last thoughts on where's your ideal 2026 location to be buying property in? Let's take it down to the metropolitan or regional area.
You know, I'm pretty open at the moment. I love things I can add value to. So I can get in there, obviously get the organic growth, but also manufacture the growth as well. I've just bought 2 in Melbourne in the last couple of months. They might continue to buy there. Tasmania is obviously looking really good rental yields. I think that's it. I've got a subdivision finishing over in Perth. Last thing we'll say in Perth as well, it's taken about 2 years to do a simple subdivision corner block. And that's one of the worst states to basically provide housing there, which is great. I'm making a killing because it just keeps going up in value, but it just shows how long it's taken the government to allow properties to be produced in these areas where they're just having massive amounts of people moving in. But I'm going pretty hard on Victoria. I think Victoria is going to be different. It's not going to be a boom or bust. It's just going to keep on growing for a while.
I'm liking Tassie, areas like Launceston and things like that. The asset types, the affordability, the yields in those areas, the yields in Victoria aren't that great. They are going to set some people back if they're not careful, if they're buying the wrong asset types. With lower yield, it's going to really stop them from being able to potentially move forward and buy future property. So I'm really think Tassie's going to do really well. And certain parts of New South Wales, definitely.
I'm on that train.
New South Wales is looking really good. It's a little bit early in certain areas, but definitely the forecast is looking fantastic.
The forecasts do look fantastic, and ironically, it's where we are located, yet I don't have a property here. So I'm keen to get into the New South Wales market, which is quite ironic. You know, even Albury-Wodonga has got some legs on it, and we're watching that quite closely too. Obviously, the borders, there we go, between Vic and New South Wales. But, you know, Wagga, Tamworth, they look like they're on the horizon. And there's a few pockets that we're watching there too. And we're quite excited to get into that as well. Well, guys, thank you very much for your time today. And obviously, we hope to do this again soon. Now that we are back to a semi-so setup, I think next episode we'll have the curtains up and we'll be able to block it off properly. Thanks very much for joining us. And until then, guys, thanks very much for joining the Lazy Equity Podcast. We look forward to helping and educating our listeners into building wealth through property investing. Until then, see you later.